Hi everybody, it's Ryan here, and today we're going to be looking at fiscal policy, taxes. Of course, taxes are something that everybody knows about, right? Because there's nothing certain in life except for death and taxes. But today we're going to be going into some of the nitty-gritty about it and looking at a few key features. And we're going to be able to, at the end of this lesson, look at the different types of tax, how to calculate income tax, how to evaluate corporation tax, look at and understand some of the complexities of value-added tax or VAT, and also look at the difference between progressive tax and regressive tax. So let's begin. Number one, there are two types of taxes. A direct tax is a tax levied directly on an individual or organization. Examples of this include income tax and corporation tax. An indirect tax is a tax on payment for a good or service. Examples include value-added tax or VAT, excise duties on petrol, drink, and tobacco, and business rates. Now we're going to look at income tax and how it is that you would calculate income tax. How does income tax work? Income tax is based on tax rates and bands which are published by the UK government, and you can find them on gov.uk income tax rates. As you can see, there are four of them: a 0% tax rates for personal allowance, a basic rate of 20%, a 40% higher rate, and the 45% additional rate, which are based on your income. So depending on how much you earn will determine the tax rate that you pay. Now, what's really interesting and important to know is that these tax rates describe marginal tax rates. It means that your tax on incomes above the band, it is not applied to your entire income. Here you can see a link to historic rates of income tax. Here's how we calculate income taxes. Say that you're on £30,000 per year. 12,500 of this will be taken up with your personal allowance. The tax on this figure will be 0% because it's a 0% tax rate on that personal allowance. Any income between £12,501 and £50,000 is taxed at the basic rate of 20%. This means that a person earning £30,000 would take 30,000 minus the 12,500 and find that it is 17,500 that is going to be taxed at this rate. So therefore, you take that figure, 17,500, and apply the 20% rate for that band to find that this person then pays £3,500 in annual tax. Here's an example of how to work out income tax for somebody who's earning £60,000 per year. First, you take their personal allowance of £12,500. You say, well, that £12,500 is going to be at a 0% rate, so therefore zero tax on that amount. Next, you say how much of that income is between £12,500 and £50,000. Because it's above £50,000, the entirety of the income between £12,500 and £50,000 will be taxed at 20% rate. So we've got £37,500, which is going to have a 20% rate of marginal tax. Then you say how much is above £50,000 but below £150,000. Well, because this person is on £60,000, it's a £10,000 total, which is going to have this higher rate of tax of 40% applied to it. And of course, because $60,000 is less than $150,000, this person would pay no tax at the additional rate of tax of 45%. So therefore, to work out the income tax paid, the personal allowance is tax-free, so $12,500 at 0%. The next bracket, $37,500, is taxed at 20%. And then the last $10,000 above the $50,000 additional rate cutoff is going to be taxed at 40%. Add that all together, and you'll find that this person, therefore, has a total tax bill of £11,500. To work out disposable income, you just say, well, what was the income? Take away the tax, and whatever's left over is the disposable income, income after tax. In this case, $48,500. You can also work out the average rate of tax. Remember, all of the tax rates that we looked at before were marginal, the rate of tax you pay on each additional pound that you earn. In this case, the average rate of tax is to look at the entire tax bill and look at that as a percentage of the overall income that that person makes. And in this case, you can see it's 19.17%, which is considerably lower than the 40% rate of tax that their last marginal rate of tax was charged at. As an exercise, it's a good idea to work out the amount of income tax paid, disposable income, and the average rate of tax for the following income levels. A couple of conclusions to take away from this is that if a government raises tax allowances, what will be the effect on UK taxpayers? What this means is that UK taxpayers will pay less tax because by raising tax allowances, either on the tax-free allowance or the cutoff for the higher rate, that gives UK taxpayers more money, which is protected from tax, and so therefore less of their income will be taxed. You often see politicians come up with this. Boris Johnson, when he was running for the Conservative leadership race, he was advocating pushing up tax allowances in order to therefore give UK taxpayers a bit of a tax break. What is the relationship between the average rate of tax and the marginal rate of tax? Well, as we've seen before, the average rate of tax is less than the marginal rate of tax because the marginal rate of tax is the amount that you are charged on the last pound that you earn, but because everybody has a personal allowance which is at zero, that's going to bring the average down below the marginal tax rate. And what are the marginal rates of tax? Well, as we've seen before, typically you think that they are going to be the tax bands that we've seen. 0%, 20%, 40%, and 45%. However, there are some complications that you can find within bands. For example, between £100,000 and £125,000, the marginal rate is higher because at that level, earners start to lose their personal allowance. So the personal allowance gets clawed back, which means that these people therefore have a higher marginal tax rate. This graph here illustrates some of the complications when looking at marginal tax rates. And as we would expect to see, at low income levels between 0 and 12,500, you have a 0% marginal rate of tax. When you get to 12,500, you start paying the basic rate of tax. When you get to £50,000, you start paying the higher rate of tax. But what happens at £100,000 is you have to start giving up your personal allowance that you earned originally. And so therefore your marginal tax rate jumps to a very high level above 60% before it comes back down again after you've had all your personal allowance clawed back, before you then get onto the additional rate of tax, which is a little bit higher.
Now, this is just a little bit of extra information, not really necessarily covered by the specification, but recently there was some interesting information about marginal tax rates coming up in the news, and it was because Greggs, the baker, which had done really, really well because of their vegan pasties, wanted to give all of their employees a £300 end-of-year bonus. Now, Greggs is a really successful company, although they will not ever make it in Cornwall.
No, seriously, they've had trouble breaking into Cornwall because Cornish people like local pasties. Long story short, Greggs had a really good year. They wanted to reward their staff, gave everybody a £300 payout, but what they didn't realize, and what the government didn't realize, is that for certain staff on low incomes who were receiving universal credit, by getting the £300 bonus meant that they weren't eligible for the universal credit, which meant that by getting the £300 payout, they effectively had a 63% marginal rate of tax, which is just ridiculous. These staff members would have only been able to keep £75 of the £300 bonus which they were entitled to. Now obviously it's not in the government's interest to design a tax scheme in this way, so this is one of the things that you might want to look at when you think, how can we make our tax system better to avoid these sorts of perverse incentives?
And for one other interesting example of income tax, let's have a look at Carlos Tevez's payslip.
And just for clarity, this is not my payslip. I do not earn £720,000 per month. This is a leaked payslip of Carlos Tevez of Manchester City Football Club for the year 2010. And as we can see here, his monthly pay is £747,000. His monthly income tax is £330,000, which means that his average rate of tax is, by calculation, 44.44%. Keep in mind that this is very nearly the top marginal rate of tax, because most of that tax, those millions of pounds that he's paying a year, will be above the £150,000 cutoff, which means that his average tax rate is going to be very, very close to his marginal tax rate. Most of his income would have been earned at that higher additional marginal tax rate. Corporation tax is a tax on company profits. If you are incorporated, it means that your company is its own legal entity, and as an entity, it must pay tax. On the right, you can see some information about the types of businesses that are required to pay corporation tax. The current corporation tax rate in the United Kingdom is 19%. You can see here that by historical standards, this is relatively low. Corporation tax rates used to be about 50% in the 1980s, which have then gradually reduced to the below 20% that we know it to be now. Comparing this with other countries, you can see that it's a fairly general trend. The United States as well had a higher corporate tax rate through the 1960s and 70s to the 1980s, which was then reduced in the 1980s and is now in line with the UK, just over 20% as its most recent corporation tax rate. As another example, you can see a country like Ireland, which had, again, higher corporate tax rates in the past, but which has really slimmed them down to, it looks like, just between maybe about 12 or 13% as its most recent corporate tax rate. Now, one of the reasons that you might want to think about with this is that what Ireland's trying to do is make themselves a competitive destination for where global countries can register and pay tax, because if they have a lower corporate tax rate, then it means that they might be able to lure more companies in to register their European headquarters there in order to take advantage of having that lower corporate tax rate. It's really important to be able to put together a valuation of whether or not a country should have high or low corporate tax rates. Some of the advantages of having low corporate tax rates is that it means that UK firms will have a higher retained profit for investment, which can boost aggregate demand. Higher profits are paid in dividends, which increases incomes. Lower tax rates make the UK a more attractive place for foreign investment, and so therefore the UK might attract more companies that are looking to set up operations within its borders. And it also sends a signal that Britain is open for business. Some of the disadvantages of having a low corporate tax rate is that it may reduce the tax yield for the UK government. Of course, you could then counter-evaluate this by saying, but how big is corporation tax in terms of overall tax revenue? It also represents an opportunity cost. Maybe the money that could have been collected would have better been spent elsewhere. Why should companies get a big tax break when there are other things that society could use with the money that is being foregone in the collection from company profits? Some large firms might also hoard cash, which means that they don't necessarily increase their investment. And dividend payments will probably go to the individuals who are the most wealthy already, therefore widening inequality. If you're interested, you can also see this list from Trading Economics, which shows corporate tax rates across the world. Value-added tax, or VAT, is a tax on consumption. Consumers pay this when they buy goods or services. In the UK, the standard rate of VAT is currently 20%. This is a brief history of VAT rates. You can see that the VAT was introduced in 1973 when the UK joined the European Economic Community with a standard rate of 10%. In 1974, the standard VAT was cut to 8%. It rose to 15% in 1979 and to 17.5% in 1991. And it's remained roughly at that 17.5% in 1991. A brief spell of a 15% VAT rate came in immediately following the financial crisis, which was intended to be a big boost for consumers to get consumers spending again. But following the financial crisis, in a way of balancing the budget and through that austerity, as we talked about before, they have increased the VAT rate to 20% and have kept it there since 2010-ish. If you're interested, check out the link on Trading Economics, which will show you the different rates of sales tax by country. Most products have VAT of 20%. Some products have a lower rate of 5%, and some products have 0%.
You don't have to have detailed knowledge, but it's useful to be aware of the fact that VAT has a couple of loopholes for different products. As you may know, I'm very loyal to Malcolm Barnecott's. I pledge allegiance to the brand of Malcolm Barnecott's Bakeries. I once had the opportunity to interview the managing director of Malcolm Barnecott's, and he told me that one of the major advantages for them of selling pasties is the fact that there's no VAT on pasties. Now, the reason for this is quite technical. It's because VAT only applies to hot food as a takeaway if it's meant to be consumed hot, but Cornish pasties apparently are meant to be taken away hot, but then let cool to ambient temperature, so then once eaten are not actually hot food takeaways anymore, which is why pasties are able to get away with not having VAT on them.
So this news article from 2012 talks about the fact that the government tried to put VAT on pasties, but then had to backtrack and do a U-turn because it was so unpopular. Another article here, which explains a few more interesting things about VAT and what it has zero rate VAT. Another famous example of a product which escaped having VAT is Jaffa cakes. Because there's no VAT on biscuits or cakes, however, chocolate-covered biscuits have VAT.
McVitie's actually went to court to prove that Jaffa cakes are cakes, not biscuits. And the way that they did this is they took stale Jaffa cakes and they said, look at what happens to Jaffa cakes when they go stale. They go hard. When a cake goes stale, it goes hard. When a biscuit goes stale, it goes soft. And so by bringing that in, they were able to prove that Jaffa cake was a cake, not a biscuit, and so therefore exempt from VAT as cakes are, but not chocolate-covered biscuits.
If you look through the government guidance, you can also find other sorts of VAT exemptions. Many leisure and cultural goods and services are exempt from VAT, and some things for welfare have a 0% rate, such as equipment for blind and partially sighted people or equipment for disabled people. Prescription drugs have a 0% rate of VAT, as do baby wear and children's clothes and footwear at 0% VAT. Some goods under the protective and safety equipment have either a 5% or 0% VAT. Until very recently, women's sanitary products were subject to a 5% rate of VAT, which was only abolished in March 2020.
The last thing you want to be aware of when looking at tax policy is a tax progressive or regressive?
Progressive taxes are taxes in which the average tax rate increases as incomes increase. A good example of this is income tax, because as we saw before, the higher marginal tax rates are for people on higher incomes. Regressive taxes refer to taxes which take a greater proportion of income from low-income individuals. Examples of this are value-added tax, because low-income individuals spend a greater proportion of income on consumption, and so therefore they pay proportionally higher in terms of their VAT. These two graphs really sum up the idea of a progressive versus regressive tax system really well. On the left-hand side, we see direct taxes such as council tax, national insurance, and income tax. And look at what happens with income tax. When you move from the bottom to the second, third, fourth, and fifth quintiles, which is to say as you go from lower income individuals to the top 20% of individuals, you can see that the percentage of their income increases as they earn higher incomes. Because of the way that income tax is structured, the people on the top incomes are going to pay the higher rates of tax. On the right-hand side, we see indirect taxes, such as duties and duty on tobacco, alcohol, VAT. As you can see, VAT makes up a higher proportion of disposable income for individuals in the bottom quintile when you compare it to top quintiles, which makes VAT by definition a regressive tax, but possibly not the most regressive tax. Have a look at this light blue line here, which is the duty on tobacco. As you can see, individuals in the bottom quintile group pay a higher percentage of disposable income compared to the top quintile group, where that percentage nearly drops to zero. The reason for this is because the prevalence of smoking is directly correlated with income. Individuals in the lowest income group have a higher prevalence of smoking for both male and female than those in higher income groups. And why are income tax bands structured the way they are? Because when you look at those top rate of income taxes, you can see that it's only really the top 10, maybe 15% of individuals to whom that income band is applied. So the tax structure is designed to make sure that most people in the UK are paying that 20% income tax rate.
Thanks for watching, everybody. I hope you found it interesting. Be sure to check out the description of the video to look for other interesting videos you can watch to enhance your knowledge of this topic, as well as all the information that I've included in the video. And of course, if you've found it useful, please make sure you give it a like and subscribe for more videos.